and talk a little bit more about what is ailing the diagnostics sector. And joining in, we've got Bharath Uppiliappan, who is the Chief Executive Officer at Dr. Lal PathLabs. Thank you so much for taking time out and joining in. Just give us a sense as to what has been the overall outlook in terms of the industry growth as of now, and what you're looking at in terms of individual diagnostic centers.
Great. It's always good to be back on your show. And a couple of points. We declared our results yesterday. Top line revenue came at 533 crores with a 7.1% growth over the previous quarter of the last quarter, same year last time. The previous quarter of last year. Now, a YOY comparison in the context of COVID is strictly not correct, and we would encourage you to look at the numbers and look at it from a sequential perspective. So if you look at the numbers from Q1 to Q2 movement, our numbers have been at about close to 6.7% growth. In the past, we have averaged about 8%. There has been a small drop in the past from the past trends, led largely due to flip in calendar season and some seasonality, some rains which came in a lot of the country this time in the month of September. Net of that, we are seeing that our tier 2, tier 3 towns are actually doing well, and there is some competitive pressure in the tier 1 towns and the metro cities, and we're putting in place all the actions required to compete with them and win back the business as and when required.
So let's look at the number one change, the COVID business. Thankfully, COVID is over. But for shareholders who enjoyed that huge uptick in the COVID business, that is not going to get repeated. So what happens to margins in a normal scenario? What happens to the operating leverage which you enjoyed? Did you hire more during COVID in terms of field staff, in terms of technicians, in terms of doctors? And would you be looking at cutting some costs there?
Great question. So we have always maintained that COVID is not a sustainable business. It is a short-term opportunity, and we will gear up our operations accordingly. Now, when you look at it from that perspective, and you see this quarter's margin, it has come in about 28.x%, which is broadly in line with the pre-COVID margin trends. So effectively, what we have done is to come back to pre-COVID margin levels. We have redeployed all the infrastructure which we put in for COVID into other labs, other operations, and successfully transitioned the business from, let us say, what was serving COVID at a point of time to serving non-COVID at this point of time. And this move we had planned from early January onwards, and that's one of the reasons why we will execute it successfully and come to the shape of margin profile, in spite of what is apparently a lower than usual top line growth.
The other important factor which is at play is that if I look at large corporates, they pretty much have embedded diagnostics business in the apps. For example, the Tatas, or for that example, PharmEasy, which means not only you get an advantage in terms of going to their website, buying the medicine and booking the test. Could that cannibalize the existing customer? Could that convenience come at the cost of market share loss by diagnostic chains like yours?
First of all, the numbers don't seem to indicate that. Because, there is a concept of category killers, people who are specialists in a category and people trust their website, their apps equally well, then go and do all the purchases from a singular app. Now, if you look at travel industry, there are aggregators and there are airline websites. And I think the airline standalone websites also do reasonably well in terms of generating traffic and doing direct bookings. Also, a lot of our business is actually network-led and not strictly e-com-led. We serve a large portion of the country, which is in tier 2, tier 3 cities, who still want to go into a shop physically, get a sample given out there, and then collect the reports back in the evening, or maybe take it over an app or a website downloaded at home. So it's a very large country, and we have our own customer base, which comes to us either for trust or we serve them in tier 2, tier 3, 4 cities, and they prefer going to centers which we have. Not that we don't have our own app or our own website, which is equally convenient. Yes, we don't sell medicines on those, but the traffic on those is also pretty good enough.
I'm just wondering that after the Suburban acquisition and, given how intensely competitive this industry is, wondering whether the route to growth is only via acquisitions.
No, not at all. See, we always maintain that we will have two engines firing. One is the organic engine and second is the inorganic engine. We prefer to do inorganic deals where we have a large geography presence play or a channel play to be plugged. And that is what we did with Suburban, which is a fantastic consumer brand, a lot of equity in the Western region. It was a white space for us, and it was a good platform for us to build on faster than trying to build a business there organically. In other parts of the country where we have strong presence, the concentric circle model works, we continue to expand the organic business. So when you look at us, you must always look at us saying that we will drive growth organically as well as through acquisitions.
Great to have you on the show today, and congratulations once again.
Thank you very much.
Okay,